Good afternoon and welcome everyone to our webinar today on how companies should access US investors. The US clearly represents a very deep pool of capital, and we will be demonstrating how European companies of all sizes can engage with these potential investors. This includes both institutional and retail investors. I'm delighted to welcome our four panelists today who will discuss the US investor landscape, as well as how trading on OTC markets can be beneficial for both broadening your shareholder register and increasing liquidity. Our panelists today are Jeff Callow, Investor Relations Director from Equitory, Jonathan Dixon, Vice President at OTC Markets, Stephen Nightingale, Investor Relations at Britvic, and Peter Wall, CEO of Argo Blockchain. Before we open up the conversation, it's just a reminder that everyone is on listen-only mode, but please do put any questions into the chat function on the right side of your screen. We will be answering questions at the end of the session. The panel discussion is being recorded and a replay will be available later today. A copy will also be sent to you over the next day or two. So without any further ado, I'll hand over to the panelists to quickly introduce themselves. Jeff, perhaps we can start with you.
Yeah, thank you, Victoria, and good afternoon, everybody. As Victoria said, my name is Jeff Callow. I'm a director at Equitory. For those that don't know Equitory, it's an investor relations consultancy, and we have a number of clients listed in the UK, many of whom we work with to help them access US markets. Prior to joining Equitory, I spent 15 years as a head of IR in the oil and gas space, working for two companies with significant US shareholder bases, so very familiar with the landscape of helping companies access the US. With that, perhaps I'll hand over to Jonathan.
Hello, thank you, Jeff. Yes, my name is Jonathan Dixon, Vice President of International Corporate Services at OTC Markets Group. I look after our operations in Western Europe and basically educating around how international issuers can access the US for secondary market trading volume and growing visibility and trading in the US. Okay, I'll just hand over to Steve.
Hi, thanks, Jonathan. Yeah, Steve Nightingale, Director of Investor Relations at Britvic. I guess anyone that's kind of listening in from the UK will know, obviously, Britvic is a soft drinks company, brands like Robinson's, but we also bottle for PepsiCo in the UK, which is kind of a connection for the US as well, which we'll kind of talk about later. I've been at Britvic for 20 years, in IR for 12 years or so. So I suppose I've kind of managed to survive this long, and looking forward to the discussion this afternoon.
And I'm Peter Wall. I'm the CEO at Argo Blockchain. We're an LSE listed cryptocurrency mining company, and we've been engaging with OTC markets and set up our trading with OTC markets in the last couple quarters. So I'm here to talk about that.
Great, thanks all. So let's start off the discussion with an overview of the US investor landscape, including the different pools of capital and some general practical tips on how to target these US investors. Jeff, if you'd like to kick off.
Thanks, Victoria. As Victoria said, I think it's important when you go to the US just to be aware of the landscape and the different pools of capital you can access and how to access them. In the same way you think about that when you're accessing the US and building an the UK and building an investor relations strategy for the UK. So if we think of the kind of tiers, if you like, in the hierarchy, you still have the big institutions in the same way you do in the UK, and clearly the institutions will be serviced and you'll probably use your brokers to arrange meetings with them and facilitate meetings with them very soon. I say very much in the keeping with how you would in a UK roadshow situation. And then beneath that, you've got that strata of what are called regional institutions and smaller institutions, and clearly in the UK we term that private client broker money as well, where you have the sort of specialist corporate access providers. And I think this pool of money in the US is clearly much bigger just by the size of the company, by the size of the country, and certainly you'll have some regional institutions, if you're lucky to get them to speak to you about an investment in your business, which you've probably never heard of, based in some strange parts of America, where they'll be running huge numbers of assets under management and can make sizable investments in your business. So to try and make things easier for them, there are specialist access providers in the same way we have them over here. But equally, some of them will also have rules which prohibit them from investing in companies that don't have a US dollar denominated listing. And that's where things like ADR and OTC markets can really help you access those pools of capital and broaden the potential investors in your company. Very quickly, before I sort of hand over to Jonathan to talk about OTC in a bit more detail, I thought it might be useful just to run through the kind of a few high-level sort of tips and things from my experience of how to organise a US roadshow and get the most out of it. I think first thing I'd say is it's very important to have a clear strategy. The US is a very large place, and if you just go in there thinking it's the solution to all your problems, and you just have to rock up and they'll be throwing money at you, it's clearly not the case. You need to have a very clear investment strategy and understand, first of all, probably where the types of funds are that are relevant for your investment case. So a lot of people start off in New York and Boston because it's clearly the nearest point and it's a big financial center. And I think what you'll find in New York, for example, is you have a lot more concentration of fast money and hedge funds. There's still some good long-only funds there, but then if you want it, but there's a much more greater concentration, say, of faster money. And the further west you move, generally, you find the more value funds you come across. So you want to go across to the West Coast, by contrast, they're out of that kind of flow of information you get in New York, and you'll find a much deeper pool of probably value-orientated investors. So it's really important to know how your business is going to be positioned and which type of investors you're going to be looking to access to determine where you should go and spend your time to get the right return on that investment, which is a considerable investment as well, both in time and expense, if you're going to travel around the US. The second point I'll make is understand which broker to use. If you're looking to target that institutional market, all the brokers have different strengths and weaknesses in different areas. So if you get on well with your peer companies and your peer IRs, use your network and ask them, which brokers have done a good job for you in certain areas. Find out if when you're running the roadshow, if the sales guys in the US, if they're based in New York and trying to organize a West Coast roadshow, they probably won't have the best contacts on the ground, as opposed to a broker that's using a San Francisco or LA based sales force to arrange those West Coast meetings for you. And perhaps try and find a broker which has a salesman who specializes in selling UK stocks into the US. That's really important. A lot of the brokers have those, and they will give you a far higher quality roadshow generally than brokers where a US salesman is trying to put that together for you. Third point, and I'm only going to make 4 points, you'll be relieved to know. The third point is I call it look through a US lens, if you like, and just be aware of the different metrics and some of the different terms that are used when you go into the US. So things like returns to shareholders might come up, and US investors will tend to focus on generally on buybacks rather than dividends. So if they're asking you about your return strategy, there might be a focus on that and pressure on them. Certainly one of our biggest shareholders, every meeting we had, he'd want to talk to us about buybacks, and we had to have that pre-prepared line as to how we would articulate why we didn't think that was the most sensible use of capital. And also think about any sort of different valuation metrics or different terminology they use in your sector when they're looking at valuation. So in the oil and gas space, where I was a head of IR for a number of years, they classify reserves and resources slightly differently in the US than we do in the UK. So rather than answer questions in the meeting and have to say, actually that number that's in as 30 million, under your classification it's 25, actually just put it in their language before you go. Spend the time to change the presentation a little bit and present it in that language and those metrics that will make sense for them, to make it easier for them to understand. And the final point I would make is just, it's a long-term commitment. Don't expect to go once to the US and to get a huge number of holders on your register. You might be fortunate enough that you strike lucky on the first go, but don't go there if you're not prepared to make a long-term commitment. Clearly that's been easier in recent times and lockdown, with meetings all happening on Zoom and other media interfaces. But when conferences start up again and roadshows start up again, it probably will be important to understand how much time you should spend in the US with US investors face to face. And I think that's something which we'll all be learning from as we go into the new normal going forwards. So with that kind of brief overview, perhaps I'll pass on to Jonathan, who can talk about really how to access that sort of broad pool of capital and I guess the role that OTC markets can really play in taking you beyond that institutional shareholder base and look at some of the other pools of capital in the US.
Yeah, thanks, Jeff. I appreciate that. And just to give the sort of the high-level view of the role in US capital markets, is it's quite a lot simpler than most people would assume. So the unique position we play is that from an international perspective, if you have your primary listing as a public company on a qualified foreign exchange outside of the United States, whether that be London, Euronext, NASDAQ Nordics, Australia, amongst several others, you will actually qualify, in most cases, for what's called a foreign private issuer exemption from the SEC, which means you can have a US dollar quote in US market hours for US investors, but without SEC registration, without complying with Sarbanes-Oxley or reconciling to US GAAP reporting, because what you're doing is you're leveraging entirely your home market, in this case, London disclosure, where the SEC recognized London as having very high compliance and financial standards. They said, well, actually, you can be in the US on an established public market. So that's the role that we play. It's for want of a better term, switching the lights on for secondary market trading volume across the US, because there is a misconception that it's easy for US investors, and to Jeff's point earlier, US investors just cannot simply just buy into UK securities or European securities or Australian securities. The plumbing's just not in place. So in short, what we're doing is like I say, switching the lights on and allowing that sort of conduit of trading volume from that depth of liquidity in the US, and not just from the larger institutions, but also the retail, which are becoming very relevant now across the US. Now, to be clear, if you're a BlackRock, Vanguard, State Street, and you wanted to buy Britvic, for example, they can come into London. There's no question. You know, they're set up to do it. But if you're a third and fourth tier investment bank, a family office, a retail fund, a self-invested 401k, pension fund, or just somebody on their Schwab E-Trade or Fidelity account that wants to buy a UK security, sort of that conduit for doing it. And that is becoming quite a large sort of investable capital in the US. And that's broadly the SEC exemption. So in many ways, you're getting a lot of what you would get on NASDAQ or New York, but from a secondary market trading point of view, without the cost and complexity of a dual listing or duplicative reporting, which can be quite heavy. In our market, just on the trade mechanics, typically there are two ways of having US investment or US settlement patterns. And one of those is via an ADR, an American Depository Receipt. And an ADR is essentially, it's a foreign equity security in the United States representing a foreign company. So it makes US investors having an easier way of being able to buy a foreign security without going into that home market. So for example, with Britvic, it just allows, with their ADR, a US investor to be able to buy Britvic in US dollars, settles in a US brokerage account, dividends are paid in US dollars, and primarily any disclosures or corporate actions are also in English. These are set up by the issuer in many ways with one of the depository banks who acts essentially as a transfer agent, or as we call it, the registrar. The second form of the way trading has developed, typically over the last 10 years, we've seen this emerge a lot more, is the ordinary share or the F share. Sorry, can we go to the ordinary share slide, if that's okay? Just the next one, please. So the ordinary share is quite an interesting trading mechanic. And without sort of boring you with too much of the trade volume and how it works, if I was to give you an example of a US investor who wants to buy UK securities and it's during London hours and during US hours. Let's assume a US investor of Merrill Lynch in Chicago wants to buy 10,000 shares of Britvic. They will go to their account at Merrill Lynch. Merrill Lynch will go to our market, see a bid and offer by one of the market makers, Citadel, Virtu, MCAP, StoneX, for example. Take that will go straight into London, trade and settle in London, hit the tape in London, print in London, and sit on the local register in London, therefore developing home market liquidity. If it's outside of London hours, the spread will widen marginally. Same principle, goes to our market, goes short, holds its principal overnight, lays it off into London the next morning, home market liquidity boost again. So in the vast majority of cases, whatever is trading in the US is actually printing back in London, whether it's live or the next day, boosting home market liquidity and sitting on the local register. So that's the trading aspect. That's the compliance exemption. I thought from a company aspect, it might be worth going to Steve now. Britvic have been on our market on OTCQX, which is our premium tier, for a long time now. And they've, Steve, you'd like to give your opinion on how US investors have worked with Britvic and the trade mechanics that you've seen.
Sure. Yeah, thanks, Jonathan. And I think a lot of things that sort of Jonathan and Jeff touched on kind of resonate and I'd recognise. So as Jonathan said, we've been on an OTCQX platform for a number of years. And I mentioned when I spoke earlier is that, obviously we're the franchisee for Pepsi here in the UK, which gives us a slight edge, I guess, as a UK FTSE 250 company, because we've got something that US investors can relate to. So there are a number of US investors that look at beverages around the world, who look at Pepsi franchises, and they'll kind of see us within that. We see ourselves as more than just a franchisee or a bottler for PepsiCo, but it's a good hook or a lead into. So I think making yourself relevant for US investors is quite important. So if you're a uniquely British or European company is how you can kind of make that kind of relevant for your US investor market. I think as Jeff said at the start, I think when we listed in the market in 2005, and I think the ADR followed probably about 18 months or so later, is the natural start point tends to be New York and Boston, I think. And there's a whole raft of banks that will take you there. And I think my early experience is you don't see a whole load of people who actually have probably got very little interest in buying your stock, or if they do, they've probably traded it back in and out 2 or 3 times by the time your plane has landed back in London. So you can basically bounce around and meet lots of hedge funds on a kind of an hourly basis, but do you really want to? Is there any real benefit for you to do that? And as Jeff said, there's some huge pools of money way beyond London and way beyond Boston and New York. And I guess my experience is with the kind of big tier 1 brokers, and we work with all of that, and we're covered by 18, 19 analysts now, most of the tier 1s, is they're very keen to take you to Boston and to take you to New York, but actually there's very little conversation about kind of going kind of beyond that into the kind of, I guess, into the kind of flyover states and over to the west. And I think, as Jeff said, it is a long-term commitment. And my early experiences were flying to some far-flung places for maybe 1 or 2 meetings before you jump on a plane, and then basically you're off somewhere. You're kind of thinking, well, it's like I've had 2 meetings and I've had 5 flights today, and I'm not really sure what's happened, to be honest. So I think as we go forward in this kind of post-pandemic world, I think actually connecting with people beyond the kind of East Coast is actually probably going to become a lot easier. So I think there's much more kind of acceptance, I think, around Teams or Zoom, etc. So I think trying to access those pools of money way beyond the East Coast should actually be a lot easier, I think, going forward. So I think traditional road shows internationally are going to be much more challenging, I think. So if everyone's on a hybrid working model, you can see a scenario. I mean, at the moment, we can go to New York and probably fill a day and a half of quality meetings. So to manage your expectations, we're a 2.5 billion cap company. I think the reality is it's a day and a half for us of decent meetings. We'll probably do 2 or 3 days of lots of hedge fund meetings, but that's not really where we want to go. And as we go forward, is actually, we could you see a scenario where you go to New York for the day, you find actually half the fund managers that you want to see are working from home that day. So I think over the next 2 to 3 years, it could be quite transitional, I think, before until things kind of really settle down. So I do think the tech will make accessing money a lot easier going forwards in that respect. I think for us, what's been really helpful with the kind of ADR program and the OTCQX relationship has been, I guess, kind of 3 big things really. One is that kind of ease of access for investors in the US to buy Britvic shares, and Jonathan just kind of touched on the kind of technicalities of that, and that's benefited us a number of times where we've seen investors who've been interested in Britvic and have actually bought directly through the ADR program. And I guess we've oscillated between probably kind of 2, 3, 4, 5% of the share register held directly in ADRs, but we've also seen a kind of parallel benefit of investors that we've met because of that sort of news dissemination across the US who became interested in Britvic because they've seen the news flow from OTCQX, and actually they've been able to buy ordinary shares, so they're not being kind of restricted in that respect. So we've seen a parallel benefit of direct holdings in the ADR, but also people that have come across Britvic through the OTCQX platform and actually bought direct. And then I think the third aspect is, we've got, the technicalities are way beyond my capabilities, but we've got blue sky exemption, which I'm sure Jonathan can come back and explain around. But essentially that gives brokers, that gives them the kind of license to recommend Britvic to their clients as an investment. So if you don't have blue sky exemption, I think there's a whole number of the states within the US that basically it becomes much more difficult for you to kind of trade into. But, so I'll leave kind of Jonathan to kind of come back on to talk about blue sky, but definitely I would say is there's some real good long only money in places that you've probably never considered before. So we've got investors on board from places like Austin, from Atlanta, Santa Fe, and obviously the West Coast. As Jeff said, you tend to be more value orientated as you kind of head across, and you got the likes of like Artisan Value, or you've got Brandy's, for example, over on the West Coast. But we've even had top 10 shareholders in the last sort of like 5-6 years, like from Des Moines, for example, and also like Waddell and Reed, kind of down in Kansas, for example. So there is some huge amounts of money, and I would say the more you move away from New York and Boston, I guess the kind of longer term profile that you tend to see from investors. So people at the kind of the teachers' employment funds, retirement funds, for example, that are kind of littered across Texas and across the West Coast.
Thanks so much, Stephen. And Peter, on to you. Argo Blockchain has performed incredibly well this year and now has a market cap of over 700 million. So it's been a really impressive share price performance. But to help us understand a bit more about Argo Blockchain, can you give us an introduction to the business and how trading on OTC has worked for you? And perhaps you can tell us how you've used this trading to access US investors. And is it the US investors that have helped drive this incredible share price movement?
Sure, and I apologize, I've been having some internet connections at home here. So hopefully, speaking of working from home, Stephen, hopefully it will stabilize as we go. Is it seem okay? Can you hear me okay now?
Very good. Okay,
great. So yeah, so Argo is as I mentioned when I introduced myself, is a publicly traded miner. One of a handful in the world now. There's 6 or 7 companies like us that mine cryptocurrency and trade on public markets. The majority of our peers are trading in the United States or Canada on TSX. So we chose to be listed in London, listed in 2018, in August of 2018. And we're, for the first 2.5 years of our existence, a small cap, cryptocurrency mining company that not a lot of people paid a ton of attention to, and had, relatively low. I think our volume was 2 or 3 million a day, kind of on average, sometimes less, sometimes more. And we have all of our operations in Canada. So I'm in Canada. Well, Canada or the United States. We have facilities in both Quebec and in a couple different or 3 different U.S. states, and our team is distributed around the world. And so our shareholders we're kind of in a unique position because our shareholders are, for the most part, historically have been in the UK. Our operations are in North America, and a lot of the energy, particularly in the cryptocurrency space, is in the US and in Canada. The UK has been a little bit slower in adopting crypto, and so for us, we were kind of, especially if you go back to when I took over as CEO in January. I've been with the company since inception, but I took over as CEO in January of last year. We were fighting some kind of headwinds with trying to convince more traditional UK investors that cryptocurrency and a publicly traded company in the cryptocurrency space was something to take a look at and to have an opportunity to grow with it. So that's kind of a little bit about the company. In terms of our experience with OTC, so I sent an email to Jonathan, I think it was September or October of last year, saying we wanted to explore an OTC, and I always say listing, and I know I'm going to get in trouble from Jonathan, an OTC trading opportunity, because it's not officially a listing, but we think of it as we thought of it as at the time as kind of like a baby dual listing. It really give an opportunity for US investors in particular to have access to our company. Again, under this context that there's a lot of excitement about technology and cryptocurrency in the US in particular. So we started the process in September, and kind of went from there. And I can get into the the granularity or the granular details if you want, but the gist is it's been a really important part of our growth over the last 6 months. Having an exposure to that particular part of the market. I mean, we're in a industry and an ecosystem that has really been primarily driven by retail investors, and so the opportunity for retail investors in the U.S. to buy our stock has been a really important part of our growth. And there's been a kind of a push and a pull across the Atlantic on a daily or weekly basis. We've had enormous amounts of volume on both sides, and certainly our OTC volume has been really great. And I think more and more we're seeing retail become more important as as an investing kind of force, especially when you're in kind of new technology spaces, whether it's electric vehicles or cannabis retail tend to be I think and just certainly that's the case. That's been the case for cryptocurrency and for us.
Yeah, thanks, Peter. I just taking on from that retail investor theme. Jonathan, perhaps you can discuss the rise of the retail investor in general in the US. I know you've been seeing a lot of flow and a lot of volume, so if you could talk around that, please.
Yeah, sure. Thanks, Peter, and thanks, Victoria. That's a really good point, and I think the tides have changed a little bit, where retail investors were almost, in some ways, seen as a bit of a problem or a hassle. Getting those late night telephone calls from an investor who was a bit miffed about something. But now, due to technology, the way we've moved forwards, we are starting to see significant levels of volume, particularly in the US, from the retail. And it's important to remember what the definition of retail is. It's massive, it's huge, it's broad. Now technology is in place, people can buy and sell on their phones very easily. I mean, in the first quarter of this year, the US dollar volume we did on our market was just a shade over 228 billion US dollars. And a lot of that is driven by retail investors. I think I pointed out earlier to the fact that we, as a market, yes, all the major banks and brokers are plugged in to our market, to our established public market and platform in the US. But it is the E-Trades, it is the Fidelities, it is the Schwabs, it's the guys who have the access to information now, who can really drive and make significant increases and developments in share prices where historically we've not been able to see it. And I think it's the new Biden administration has certainly driven that forwards. I mean, we've heard today 2 AIM companies have joined the market today, OTCQB and QX. Helium One Global on AIM joined our OTCQB market, which is our venture market for smaller companies looking to get their toes into the US. And again, it's renewable, it's cobalt, it's lithium, it's anything which is driving with that new administration, which is getting those retail investors excited. Gaming Realms, another AIM company, taking advantage of the deregulation in gambling in the United States. The US is an obvious move for them, and I think that's the next step, and it's retail which is driving that again. And I think it's I keep harping back to it, but it's really important to remember the power of retail and the power of regional retail in the US, because we always have the assumption that it's the big cities, but it's the small towns in Kansas or Texas, or wherever it might be, that wouldn't normally have access to be able to trade these companies. Suddenly the lights are being switched on, for one of them.
Yeah, on the same topic of retail investors, Argo Blockchain has attracted significant retail flow, as you're talking about. Peter, what do you do to communicate with the retail investors, and are there any differences between UK and US retail investors?
Sorry, I was muted. It's a good question, and I apologize if there's a bit of a delay on my side. After I finish talking, you guys have nodded for a while, and then maybe there's a delay across the Atlantic today. So in terms of what do we do back to retail investors? I think, first of all, we have tried to be as open and transparent and communicate in as much as we can as a public in a transparent. So we put out monthly operational updates, which goes above and beyond our regulatory duties. We do a lot of engagement on social media. We do Twitter Q&A videos. We kind of treat, going back to what you were just saying, Jonathan, about how retail investors, I think, used to be viewed, and how certainly we as a company are viewing. We love our retail investors. We think that they're a really huge part of our story and a big part of what we are. So I take them very seriously. I give them as much attention as would any of our shareholders, any of our large shareholders. I mean, I remember when I first took over this company, I went to London in January, met with a couple different hedge funds, and it was fine, it was great, but I came out of those meetings thinking, I think there's an opportunity for us to connect with, and connect with kind of average people who believe in in the sector that we're in and who want to invest in it and who just need to understand, who really want to understand kind of where we're going. So I've tried to be, yeah, like I said, transparent, open, communicative, approachable. And that's just kind of natural for me. It's just sort of who I am. I think, you know, you have to give people credit for being smart, because our investors are smart, our shareholders are smart. They ask good questions, they challenge us. And I accept all that, and I think that's I think that's been part of what they've liked and what we've liked about that relationship. In terms of the difference between U.S. and UK, I mean, we are still very much, well, we're both. I mean, we're probably a third of our volumes in the U.S. now, and 2/3 is in the UK. So there's the UK shareholders tend to be a tribe now, because a lot of them have been around longer and they've been part of the story, and many of them have, you know, have done well with our share price. And so it's a little bit more, yeah, to use kind of, for lack of a better word, it's a bit more of a tribe and a group of people who have found a company they like. And I think the US is newer. We're building that relationship. It's bigger. It's slightly different, but we're trying to take kind of a similar approach to our US retail shareholders.
I might just add there, I think Peter makes a really good point, and it's specifically a valuation-based process. Where do Americans look at international companies in the UK, for example, and how do they value that? Do they seek fair valuation? And I don't mean the hypervaluation that we may be seeing now or may not be seeing now. However, fair valuation, a US investor, whether it be retail or institutional, may look at a UK company and think, well, it may look at a UK technology-based company and say, well, the Brits have no idea how to value a UK technology company. We've got the pick of the bunch on NASDAQ or New York, but now we've got an opportunity to get into the UK and really get involved at what they assume could be the ground level. So it's the way we value things. It's the different sectors, and I think retail specifically look for those opportunities to seek fair valuation in overseas companies, which they wouldn't ordinarily have access to.
Yeah, I think that's a good point, Jonathan. I think that's what I was kind of referring to that when I was talking about the push and the pull. Like, I think we saw at the time, like, we had this re-rate that happened, you know, in December, January, and you and I were communicating then, and you were like, wow, I've never seen anything like this. The volume is coming out of the US and the excitement about, you know, this company, meaning our company, which was great. And the feeling was, yeah, when you look at, you know, the sector as a whole, and you look at various companies, well, one of them is obviously not, you know, being in the same, looked at in the same level, or valued in the same level. So there was a, this kind of re-rating that took place. And I think a lot of that was absolutely driven by US investors who were looking at kind of, you know, looking at peer groups and saying, what stands out here as being undervalued. The other thing I'll say is that, and this may or may not be relevant, but we also, or the other thing that happened in kind of December, January, is that there was a number of kind of, you know, for lack of a better word, kind of YouTube analysts who all of a sudden took an interest in our share and in our stock and in our company and in our story, and started communicating that to you know, this retail market. And again, I took those guys seriously. They were really smart. They asked really good questions. I mean, I went on their, in one case, I went on their video, you know, their channel, and did an interview, and they're smart. Like, they're paying to us more attention to us than many kind of retail or research analysts, you know, at brokerages in London, and often know the space better. So there is this shift that's happening that I think, especially small kind of caps, you know, micro caps, need to pay attention to, which is, and I've been advising a couple other companies in this, and yeah, you want to take these opportunities seriously. There's a shift that's happening. There's more power and more information in the hands of ordinary retail people, and borders are breaking down. So OTC in particular, I think, has a great opportunity here to take advantage, and small, not every company is going to trade well on both sides of the Atlantic, but I think in many cases there's this new kind of internationalism that's taking place around stocks, and certainly for us it's been really significant.
Great, thanks, Peter. I think sort of as we're nearing the end of the formal session, we might just go back to the institutional shareholder and perhaps a general question for both Steve and Jeff. And if you could talk really about the importance of a well-executed IR strategy and particularly focused on the US and what you would typically do at Britvic and Jeff with your companies and how you would look to approach the US and if it's any different in terms of your IR strategy. And Jeff, would you like to start off maybe?
Yeah, by all means, thanks, Victoria. I think like anything, it's about having a clear strategy is the important thing. It's not just turning up and as Stephen said, rocking around New York. You'll get those meetings, but it won't necessarily get the best return on that investment because it really resonated when he said there'll be in and out stock by the time you've got back to London, God knows how many times. So it's making sure that you, as I said, it's not clearly understand what you're trying to achieve and you've got some clear objectives that everybody's committed to. I think you also need to be aware of some of the differences perhaps in the nature of the US market. So for example, they don't have the broker model over there. So particularly when you get into things like transactions and things like that, it can be worth aware. They're not aware of wall crossing. It's a very alien concept. So I'm getting to sort of quite granular technical specifics now, but if you are ever doing a transaction, then don't be surprised to have your top shareholders phoning up if they are approached for a wall crossing and sort of talking to you and saying, who's this person from X bank that wants me to kind of sign some piece of paper so I can talk to you? Why can't I pick up the phone and talk to you? So it's trying to explain things like that and be aware of, say, the differences in the model. I think another thing when you're going to the US is being aware of the fact that, you know, the model over there is such that they're not used to, companies are quite happy dealing with IR only. They don't have the same level of interaction with the sort of the C-suite, as they call it, as we do over here. And I think probably because of the proximity we have in the UK to the management teams, a lot of fund managers do expect, or particularly their big shareholders, to interact with management on the back of large strategic initiatives. And I find US shareholders are much happier to deal with IR only. So from a management perspective and a time perspective for management, the demands are much less than they would be with dealing with UK shareholders, because IR can pick up the vast majority of that, and the first port of call into your largest shareholder will often be into IR, which is very beneficial. And I think that goes back to Stephen's point about not just, you know, when you go out to some of these places, which are quite arduous, if you want to go and pick off the Texas teachers of the world and the Wasatches and people like that who are perhaps in one or two cities, and you know, there's a growing number of fund managers based in somewhere like Denver now, but it's still, you know, so it's kind of a stop off to see 3 or 4 funds, and it's growing, it's getting bigger because it's a nice place to live and it's got good roots to the rest of the US. But you know, that's quite not really the best use of management's time. So IR can go and lead those roadshows, certainly in the first instance, while you kind of introduce the strategy, introduce the business model, and have those kind of filtering conversations before you then send management out to meet them or introduce management on a separate call. And the final thing I think I'd really say is really build direct relationships, I think, with the US investors. I think one thing we say to our clients at Equitory all the time, particularly post MiFID II, is in relation to UK shareholders, is, you know, don't rely on analysts anymore. The analysts are consolidating, you know, coverage universes are shrinking, and so it's important to make sure you take ownership of that relationship with your investors yourselves, using social media, as Peter was talking about, using some of these other channels to build that direct relationship. But particularly in the US, you know, you can really foster that, because your sell-side analysts, some of them will have good relationships with the people in the US, but a lot of you, particularly UK mid-market brokers, don't really have that depth of relationship with the US shareholders. So that's something you can really build for yourself and own yourself. And it's really important to do that, because if you're in a transaction or something like that, I've certainly been in transactions where UK analysts were suggesting that sort of there was the deal would struggle because shareholders weren't supportive, when they were talking to a small subsection of UK shareholders, because they didn't have the relationship and the reach into the US and the relationship with those US companies. Whereas as a corporate, we did. So we were able to talk to those analysts and say, look, you're not speaking to 40% of the shareholder base, and I can tell you those 4 institutions which represent that 40% are all hugely behind this deal. So when you have that conversation, if you've got the trust with the analyst, then that noise went away. So it's definitely one to take ownership of, build that relationship yourself. If you do have big holders over there, then, you know, I think when you're building your IR plan and strategy, you know, we had big holders on the West Coast. We try and make sure we did a 2-hour meeting with them rather than a 1-hour meeting, because we see them once a year probably. So let's build the time in. If you have got big shareholders on the West Coast or somewhere in the US, try and make use of the time, not just to see them in a meeting room, but build that relationship. So maybe go out for dinner with them the night before if you arrive in late afternoon, or if it's the end of the week and he's finishing on a Friday lunchtime, if they play golf or something, kind of a game of golf, whatever it might be, just to try and build that relationship a little bit outside of the formal meeting room. And they're normally quite receptive to that because they want to get to know the management teams and the IRs of the companies that they're investing in as well. So it works on both ways, and they're probably interested in chewing the fat on other companies in your sector they could invest in. So that's just a few kind of observations, I guess, from myself. I hope they'll rest with you, Stephen.
Yeah, I think, no, I agree. I think it is a big commitment. I think, and especially for IR, because I think in terms of CEO and CFO, I think it's relatively common practice to take kind of your CEO and CFO to go to New York and Boston. I think kind of beyond that, I guess the business case for visiting half a dozen different cities across a week for maybe 10 or 12 meetings is quite challenging, especially when it's a kind of introduce the company. So I think they are very much IR led. So I've had many a week over the last sort of 10, 12 years, kind of trekking around the US on my own for a week, visiting various places. I think once you then kind of build up interest, the reality is, I think my experience is people are incredibly grateful for you making the effort to go to Colorado or Des Moines or to Kansas and stuff, and they recognise the fact that you probably come there for 2 or 3 meetings because they're fairly small centres of capital, lots of money, but there's only 3 or 4 funds there, so they know you're there for 2 or 3 meetings and you're on your way. So they're always incredibly grateful if you go in there. And what I guess our strategy has been to kind of do the IR led, and then where we've seen stuff that's worth kind of following up on, or we come on the share register occasionally someone buys shares on the back of talking to me, not very often, to be honest. But what you can then do is kind of leverage conferences. So we go to various conferences, which could be East Coast or West Coast, and at which point those investors from those kind of the flyover states and Texas, for example, you'll see them there. So having seen them down in Austin or in Des Moines, they'll be there in person in New York or Boston or San Francisco. So we tend to try and leverage that kind of model in that respect. And I think just to kind of follow up on a couple of points that Jeff made there is, I think, depending on what kind of, they don't have the broker model, so that does create the nuances. They don't understand this kind of, you've got an over-the-wall bank. So, for us, it's Citigroup and JP Morgan, and then, the US investors kind of perplexed by the fact that you've got someone who's ringing up on your behalf. And it does cause a challenge, I think, in 2 ways. I think one is in terms of your capital allocation, as Jeff touched on earlier, is there's definitely much more of a preference towards share buybacks rather than special dividends, as you see in the UK, primarily for tax reasons. I think it's not always the case, but I think be really clear about if you're a cash flow company and you want to pay lots of dividends, then suddenly going to the US and trying to get loads of US investors on your share register, are actually probably more preference towards a share buyback. You may be kind of setting yourself up for a bit of kind of tension at a later stage. And likewise, from an M&A perspective, if you're issuing equity, as Jeff said, is over here you can quite often take your big shareholders over the wall the night before and explain to them the kind of transaction. We've never done that yet with the US investor. They've always declined the opportunity. They've actually said, well, sometimes I'd like to, but literally I can't do it. I can't be taken over the wall. And they don't even know which company it is necessarily, because the brokers will approach them and say, we've got one of your companies wants to take it over the wall, and if 9 times out of 10 it's a flat no. And I guess the challenge there becomes around the next day when you're issuing shares, obviously, because they'll go on the market in London in the morning. And your US shareholders, if they're not aware of the deal, by the time they wake up in the morning, those kind of shares have already been allocated. So that can cause a bit of tension sometimes if they feel like they've missed out, or if you can hang out long enough to try and get them on the share register. And I think to kind of Jeff's point is, don't just rely on the kind of big brokers. I think we've used a variety of brokers. I've even looked at companies that are kind of peers to us, looked at their sell side page on their website and see which analysts cover them, and there's definitely brokers there that don't cover us. And I've reached out to them directly, and they've put me in touch with their corporate access teams, and then basically got meetings on the back of that. So I think not having coverage from an analyst shouldn't be a blocker to actually for them to arrange meetings with you. So we've worked with the likes of Baird, for example, and other kind of US houses that have got no presence here in the UK, but they're very happy to put you in touch with their clients in the US.
Yeah, I'd just coming back, I'd agree on Stephen's point there completely. One of our clients we do a lot of work with at the moment in terms of expanding. So it's a large tech business, and we've been doing a lot of work with them on expanding their reach, particularly in the US, and looking at those analysts that cover them, and we did very detailed peer group analysis. Look at all the analysts that are covering the different companies in the sector, and trying to work out who we could approach, as Stephen said, and then work out who might have the best conferences. And the phone calls we've made have been pretty cold phone calls into some of these people, but they're delighted that big UK companies interested in talking to them. And I think they recognise that if they can attract someone like that to their conference, it's actually a point of differentiation for them as well, for their conference, which might be more of a traditional US one. But it's a good way of brokering that relationship. And they don't need to actually cover you. If you build that relationship and maybe just catch up with them for a coffee or something when you're passing through town, you'll find that they will, talk about the stock and talk about the company in meetings and to investors, even if they're not actually, as I say, writing on you and officially covering you.
Yeah, and I think, just to kind of build on that, we've done some stuff directly with OTCQX team, so with kind of Jonathan and Bob Power and Jason in the US, where we've done those kind of 2-minute videos that are kind of posted on their website and appeared in the newsletter. I think I guess we've seen over the last 18 months or so kind of the emergence of the kind of virtual conference, especially the last 12 months, and we're planning to do one with the kind of with kind of Jonathan and the team in a couple of months of kind of accessing Canadian investors. So I would just say just leverage whatever platform you can really to kind of drive your kind of accessibility.
Brilliant, thanks both. We might just have one last question before we move to Q&A. So if you do have any questions, please do pop them in your chat box. The last one really for you, Jonathan. You touched on Biden a bit earlier, but what is the impact of the Biden administration in general for the markets and investors?
Yeah, I think that there's no slowdown of stimulus, and without trying to speculate on the direction of what is going to happen over the next 2 months, year, there still seems to be a lot of money in the system, which is still driving it. Sector specific, I just wanted to point on some of the sectors which we're seeing quite a lot of activity. Resource tends to be a big sector. It doesn't matter what administration it's in, resource will always seem to be a big sector, but it's renewables. Renewables are really interesting. The Biden administration has taken a massive stance on that. Clean energy, clean tech, biotech's very obviously in flavour. It never really isn't, but at the moment, over the last 18 months, it certainly has. So I just wanted to make the point that I think as it stands, the Biden administration has taken a different stance, but it's very much towards technology, clean technology, and moving away from some of the traditional sectors that we have seen in the past under different administrations.
Great, well, thanks. I think that wraps up the formal part of our conversation. I think we have about 10 minutes to go. We have a couple questions coming through, but we'll hopefully try and get to all of them. If you have any more, please do add them in your chat box. And the first one we've got, actually, Jonathan, just how much does it cost to trade on OTC, and how long does it take to get up and running for an average company? And maybe Peter can give some help on how long it took him as well. So maybe kick off, Jonathan, with costs.
Yeah, no, it's a good question, and there is a misconception that getting to the United States is going to cost you an arm and a leg, enormous amount of lawyer fees, banking fees, and what have you. But the key point to remember with the way that the OTC markets works and OTCQX and QB, it's important to always remember you're leveraging home market disclosure. That's the most important factor in the whole process. So there is no sort of additional ongoing larger costs to third parties. Be straight to your answer, the annual fee for OTCQX, which is where the likes of, Argo and Britvic trade, the big established companies now, it's $23,000 a year. That's our annual fee. And that covers all the trading mechanics, a lot of visibility, but we do help a lot with the visibility, like Steve mentioned earlier, but also compliance. That's a really important point. And we may come back to Blue Sky if we get a question on that, but that's quite an important factor. So the long and the short of it is OTCQX, the annual fee is $23,000. OTCQB, the venture market, is $14,000 a year. And there is a startup cost of $5,000 as well. That's to get through the application process. And typically, the time frame is 4 to 6 weeks. Argo was a bit longer. It really was a bottleneck with the regulated FINRA at the time, primarily due to COVID. But that's generally it. Peter, I don't know if you want to talk about your experience.
Yeah, no, sure. Yeah, the only thing for us is we've gone from QB to QX, which was kind of a move, and actually we started as a pink sheets, which wasn't, we didn't spin up ourselves. What happened was when we put our application in for QB, which is the first level, someone in the US who really wanted to buy and sell Argo shares started a pink sheets listing. or a pink sheet trade, and that can be done without the company's approval. So that went live in mid to end December, and then we had our QB go live in January, and then we upgraded to QX in February. So we've been kind of like in all levels of the, you know, AA, single A, AA, AAA, yeah, and all of them have had a good amount of volume and have been good for us.
Yeah, thanks. Another quick question. How large does a company have to be to trade on OTC? Typically, you know, who are your smallest clients, and what size generally are companies that come to you to start with, Jonathan?
Yeah, good question. And again, it's a misconception in many ways, because what we describe as a nano cap or micro cap here might be a real tiddler in the US. It really does depend. A $1 billion company is not a particularly big company in the US. So there is this misconception that I'm too small to get in the US, my story won't resonate. But the reality is, you know, we've taken £2 or £3 million businesses from London, from the Aquis Exchange, for example, or smaller AIM companies, which have gone on to do very well in the US. I mean, pointing to an AIM company, Applied Graphene Materials, was particularly small. Well, not particularly small, but small. Not by UK standards, but by US standards. But they've gone on to trade very well in the market and become very well established. And they're now a well-established business, both in the US and in the UK, and they've grown visibility as well. I might add that they take advantage of their visibility opportunities as well. So in answer to your questions, no one too small. And, you know, at the other end of the spectrum, I think our largest client is probably Roche. Roche, primarily listed in Switzerland, one of the largest pharmaceutical companies in the world. And I think they've been with us since 2007. So it's right across the spectrum, and it's really about how you deliver the story in the US. That's critical, but you need to be present. And fundamentally, the most important thing is you actually need to be tradable. So it's fixing that actual plumbing, which is the critical component to being able to do it.
And is it a stepping stone to trading on NASDAQ, for example?
Yeah, no, it's a good question, and it just comes up all the time. Peter will tell you that. It's the reality is that, yes, a lot of companies want to be on NASDAQ. A lot of UK AIM companies want to go to NASDAQ, which is absolutely fine. You know, my argument would be ready, be set, have your shareholder base established in the US, make sure you've got good visibility. And last year, I think we had 60 odd companies graduate from OTCQX and QB up to a national exchange being NASDAQ or New York. But they're ready. You know, they've established their footprint into the US. I guess we lose a paying client. However, it's a good success story ultimately down the line. But yeah, to your point, yes, it's in many ways we're not an alternative, because if you're going to NASDAQ or you're going to New York as a UK issuer, for example, you are going to be issuing more shares. You are going to be SEC registered. It's going to be a number of factors that you're going to have to get through. So if ultimately NASDAQ or New York is the ultimate goal, we can try and be that conduit to help you develop that in a sort of cost-efficient, compliant, and light touch manner by leveraging that home market disclosure.
Brilliant. And one more technical question for you, Jonathan, just popped up. Blue Sky compliance, I believe Stephen was talking about that earlier, but what is that?
Okay, well, if you're not asleep, you will be soon. So Steve makes a good point. So I won't ram this down your throat, but I will tell you, if you are not on the New York Stock Exchange, or you're not on NASDAQ or QB or QX, or what's called an established public market in the US, it's against US securities law to be recommended to be put in private client portfolios or have retail or have distribution distributed below institutional level. So all your distribution of research has to be at institutional level unless you're on one of the main markets like ours. When you switch the lights on for trading on OTCQX or QB, you get a blanket blue sky exemption. On QX, it's 37 US states. On QB, it's 34 US states. And what that means is that if, for example, Raymond James in Dallas, like the story of Argo Blockchain, they can start recommending it to their clients. So you're not opening just up the execution-only secondary market trading volume. You're soliciting business. You're compliant in that state. So as a small cap UK issuer, for example, not only are you being traded, but you're being recommended. You know, UBS in Ohio, it doesn't matter where it is, those brokers and banks can actually take the story in take the research in, consume it all, and then start recommending it to their clients, which really does shift the needle on the local register back in the home market.
Great. And a question for, I guess, Jeff and Steve. We're talking a lot about traveling around the US, but obviously in the past year, there have been a lot more Zoom meetings and team meetings. And have they been good enough? How many roadshows do you envisage that you're going to need to do in person next year versus physical ones? And how many physical ones, well, Steve, probably a good one, how many physical roadshows have you done in the past, and how many do you envisage doing going forward?
Do you want to start, Jeff?
Yeah, go for it.
Yeah, I think in a kind of pre-pandemic world, we would gear up for taking management to the US for interims and prelims. That usually be like 3 days, 2 days New York, 1 day Boston. And then outside of that, we'd probably do a couple of conferences. And obviously, we're in a consumer staple, so we'd go for a couple of big conferences, one on the West Coast and one in Boston normally. So probably 4 trips a year. You don't. And then on top of that, I think from an IR perspective, I might go for 1 or 2 weeks on top of that. So I might do 5 or 6 trips to the US a year. And let's say a couple of them are like flying visits for conferences or for results roadshows. I think interestingly, I think historically, everyone would all say to you, if you go to, if you want to speak to investors in New York, you've got to go with management and you've got to go in person. They won't do it over the phone. You've got to be there in person and stuff. And I think that's been completely flipped over the last year, to be honest. And I would say the connectivity of Teams and Zoom has actually probably, I would say, strengthened those relationships with our US holders, because actually they get in touch now more frequently. Because they can just quickly drop your question, can we catch up on a Teams call, jump on for 15 minutes or so. So I think it's made it much more kind of connected, to be honest. I think as we come out of this and go forward, I kind of touched on it earlier, I think it's going to be a little bit challenging, actually. I think initially, so going back to that original, results are out on a Thursday, we're going to fly to New York at the weekend for 2 or 3 days. That may be quite complicated, I think, in the first year or so, because of who's going to be in New York, in their New York and Boston offices. You can see the irony of flying all the way to New York to do Teams calls from a broker's office, or from a bank's office, for someone who's basically at home in Connecticut or New Jersey or something like that, for example. So I do, this is just a personal view, is I think, be that conferences or micro conferences, I think may become more important. So I can see a situation where, a US bank will say, look, we've got 3 or 4 British companies over this week. It's not an official conference as such, but actually, do you want to kind of come in and see them? And I can see that situation where we've got a room in the bank and maybe a half dozen clients coming in over a couple of days and stuff like that. So I think there'll be a hybrid model of, road shows, micro conferences, and actually, continuing with kind of Teams and Zoom calls. But I don't envisage we'll go back for both interims and prelims. When I speak to some of our big shareholders who are based in the US, I think their expectations are is that maybe you'll come over once a year now, rather than the twice a year that you used to.
Yeah, I think I'd agree with that, everything Stephen said there. I think, in terms of the amount of times and the frequency in terms of which we used to visit, it was around that. Most of our clients visit pre-pandemic. It was very much as Stephen said. I think the jury's still out. I think obviously the other thing, as well as the pandemic, is clearly ESG has become prominent, and there's an argument to say, well, should we be flying out, not just from there's the carbon footprint and everything else, and the cost of actually traveling to the US and traveling in hotels and flying around the US a lot. There's also the time and the demands it makes on management, which means it's very difficult to do anything else for those weeks. You probably don't see it, but management are often in the back of cars, wherever, frantically trying to grab a quick phone call or read a quick paper or something, and it's very difficult for them to actually be engaged with the business during that period of time because they're so busy seeing those investors. So actually it frees them up a little bit by having been able to do it remotely and from Team or Zoom or whatever you're going to use, and enables them to both engage with those shareholders but still keep their hand firmly on the tiller of the business as well at that period of time, whilst reducing carbon footprints and everything else. So I think there's a number of drivers, and we've had different feedback speaking to clients, speaking to investors around this. It's a question we ask a lot on obviously coming out of roadshow season, and some clients say actually some feedback from some fund managers has been they think that the conferences will be a thing of the past, because actually they dislike jumping up and down a lift in a hotel room, trying to find room 405 and then trying to find room 906 or whatever, and everyone running late because they always do. But then I've heard, and I think it's much more efficient to do those on Zoom. Then I've heard other people say the opposite. So actually, we think the conferences might be better than the road shows, because actually at conferences we like the ability to see people in an informal setting and spend that time at breakfast or in the bar or whatever else it is, and trying to chat to them. So I think it's still all open to sort of debate, really, as to how it plays out going forward, and we'll just see with time. But I think the one thing for certain, as Stephen said, is there'll be a definite reduction in the frequency of visits to the US, which for some of the reasons I talked about before will probably lead to be cheaper to run the PLC, which is only a good thing for ultimately for savers, and ultimately will be reducing carbon footprint as well. So there's some very clear non-financial drivers to reduce the number of visits you're having to the States.
Well, fantastic. Well, we've actually sadly run out of time, and we have a few more questions here, which we will get back to personally when we after the call, and also the replay will be sent to you all in email. And just one final very quick question for Stephen and Peter. What is your US share register look like? I mean, just in vague percentage, how important is the US shareholder to you?
Peter, would you like me to go first?
Sure.
Yeah, I checked before we kind of came on the call, actually. So currently we're at 22% US, 3% Canada, so I guess 25% in total. We've been up around 40, 45 in the past. I think, you know, it kind of ebbs and flows a little bit. I think for us, Brexit has been a hangover for 3 or 4 years now. So we've got a number of institutions that have, you know, they like the company, they like the story, but their parameters to invest have, you know, kept them away from, you know, because, you know, we're very kind of, you know, 60% of our revenues, 70, you know, more than our profit is in the UK. So therefore, that uncertainty around Brexit has, I think, has been an overhang. So I kind of fully expect that to start ramping up, and we've definitely seen more interest from US investors coming through in the last few weeks and months.
And we're at about a third stateside.
Yeah, so meaningful, very meaningful for you both. Well, everyone, I'm sorry the time's run out before we managed to get to all the questions, but thank you all to all our panelists, and thank you to everyone for listening in, and we will be in touch with you all with a replay of the presentation.
Thank you.
Thanks.